All right, welcome to the Explainer. With all the conflict in the world right now, it feels natural to think that cash is the safest place to be, right? A safe harbor in a storm. Well, today we're digging into some analysis that turns that idea completely on its head. It argues that holding cash might actually be the biggest financial risk you can take. And let's kick things off with a quote from a legend, Warren Buffett. He says, in wartime, cash is the worst asset to hold. And his point is really simple. During times of conflict, you want to own things that produce something. Businesses, farms, real estate. Cash? Well, cash just sits there, getting eaten away by a silent killer called inflation. Okay, so here's the core of the problem. When there's global conflict, it's not just something you see on the news. It has a direct impact on your wallet. Why? Because to pay for all this, governments do one thing really well. They print money, lots of it. And when they create all this new currency out of thin air, every single dollar you have saved becomes worth a little bit less. So, this money printing thing, it sounds kind of abstract, right? But what does it actually look like? And how can we see its effect? Well, let's pull back the curtain and look at the actual data. To really grasp the sheer scale of what's happening, we've got to talk about something called the M2 money supply. Now, don't let the name scare you. It's basically just a big, wide measure of all the money in circulation. Cash, checking accounts, all the stuff that's easy to spend. When you see M2 go up, it means the total amount of money in the system is getting bigger. And wow, this chart from the source material really says it all. You're looking at the global M2 money supply. Just look at that massive, almost vertical spike starting around 2020. It's like a textbook example. Every time there's a major crisis, the pandemic, a new conflict, it's like a trigger for governments to just open the floodgates. And all that new money, that's what fuels inflation and makes your cash worth less and less. Now hold on, this doesn't mean you should run out and get rid of every single dollar you have. Not at all. The point here is to understand the real purpose of cash in your financial life, and more importantly, what it's not for. So what is the right way to think about cash? Well, the source breaks it down pretty clearly. The right way is for your emergency fund, right? Having 3 to 6 months of expenses tucked away so you have peace of mind. It's for liquidity, cash for things you plan to buy soon. The wrong way, that's using it to try and time the market, waiting for that perfect moment to invest, or just holding piles of it out of fear because things feel expensive. That's a trap. And that brings us to the folly of market timing. Gosh, it's so tempting, isn't it? The idea that we can just wait for a big crash and then jump in at the bottom. But the data tells a very different story. Let's dig into why sitting on the sidelines can be one of the most expensive mistakes you can make. Okay, get ready for this number. It's kind of mind-blowing. The source we're looking at points out that missing just the 20 best days in the market can cut your potential returns in half, 50%. Now, let me ask you, can anyone, and I mean anyone, reliably predict which 20 days those are going to be? The evidence is pretty clear. Absolutely not. And this chart here really hammers the point home. Look at the difference. Historically, the average gain during a bull market is just massive. It absolutely dwarfs the average loss from a bear market. The lesson? The big money, the real wealth, is built by staying in the game, not by trying to perfectly sidestep every single dip. And this all boils down to something called opportunity cost. It's a simple idea, really. Every single day your money is sitting on the sidelines as cash, it's not just getting eaten by inflation. It's also a missed opportunity. It's a day it's not out there, invested, and potentially growing for you. And trust me, that lost opportunity can add up to a staggering amount over time. Okay, so if we agree that holding a mountain of cash is risky and trying to time the market is basically a fool's errand, then what's the alternative? Where should we be looking? Well, the analysis for breaking down points to 3 very specific types of assets that tend to do well when the world gets messy. And those 3 are Bitcoin, gold, and defense stocks. Now, this is an interesting mix, right? The argument is that each of these, for very different reasons, actually benefits from the kind of economic chaos that comes with global instability and all that government money printing. So why these 3? What's the actual data-driven case for each one? Let's get into it. Okay, now this is fascinating. This table comes from a study by BlackRock, and it looks at how different assets performed in the 60 days after a major geopolitical crisis. And look at this. While the S&P 500 was flat or down, gold and Bitcoin actually posted really strong positive returns. They were acting like genuine safe havens when things got chaotic. So let's start with Bitcoin. The argument here is all about its unique design. First, it's sanction-proof. No government can freeze it or seize it, which becomes incredibly important when finance is used as a weapon. Second, it's borderless. You can send it anywhere. And third, and this is a big one, its supply is absolutely fixed. There will only ever be 21 million. So unlike government money, they can't just print more of it. The source even mentions these reports of Iran demanding Bitcoin for passage fees. I mean, that's a wild real-world example of it being used right in the middle of geopolitical chess.
Next up, we have gold. Gold's case is all about history. I mean, it's been the go-to safe haven for thousands of years. It's the ultimate store of wealth. But what's really interesting is what's happening right now. Central banks, especially China's, are buying up gold like crazy. That's a huge signal. Even governments are hedging their bets and moving away from total reliance on currencies like the US dollar.
All right, and the third asset class is maybe the most straightforward of them all. It's simple, really. Just follow the money. When governments print trillions of dollars for war, that money doesn't just vanish. It has to go somewhere very specific. We're talking about a US Pentagon budget of over $1 trillion. A trillion! That's not just some number on a page. Think of it like a giant river of cash flowing directly from the government into one particular industry. And where does that river of cash end up? Well, it flows directly to companies like these. RTX, making missiles, Boeing, building military planes, Lockheed Martin, the folks behind the F-35 fighter jet. They are the direct beneficiaries of all that spending. This is what people mean when they talk about the military-industrial complex. But, and this is a really important but, the analysis ends with a warning. It points out that historically, great empires, think Rome, think Great Britain, often begin to decline when their military gets stretched too thin across the globe. So, while defense stocks might benefit in the short term, putting all your chips on one country's continued military dominance might be a riskier long-term bet than it seems. Which brings us to the final big-picture question. As the very rules of money are changing right before our eyes, is your portfolio built for the last war, or is it ready for the next one? The biggest takeaway here is that in a world of endless money printing and growing conflict, you have to think differently. You have to ask yourself if your financial plan is ready for the world we actually live in now, not the world of 10 or 20 years ago.